With the recent collapse of banks in the US and Europe, the question is now a good time to invest in banking stocks? That's a question I got from quite a few of you, and that's why in this video I'm going to explain you what I think about banking stocks. How else could it be? There's already a meme going around Twitter that highlights the number of banks that have been going down in recent times. Obviously there was Signature Bank, First Republic Bank, Silvergate, and then obviously the famous one that triggered it all, Silicon Valley Bank. But as you can see, there's still a number of banks to go, and already people making jokes, who's next? And who knows, right? Not so long ago, 2008, 2009, we seen a similar scenario, a banking crisis that kind of happened out of nowhere. And let's be honest, right now we're not exactly in the best economic situation we could be. There's still the looming fear of a recession. I mean, technically, are we in a recession? Are we not? I mean, a lot of people have been saying for months now the recession will hit. So far, I don't think we have seen the worst of it yet. I mean, obviously, there have been people made redundant. Inflation is extremely high across the world. But to be honest, it's not as bad as back in 2008, 2009, where we've seen real pain on the street and a lot of people losing their job. Right now, it's more concentrated in certain industries. It's not good, of course, but maybe not as painful as it was back then. However, people saying now, with some of those banks collapsing, might this be the trigger point for more collapses and worse things to come in the future? And the broader impact on other parts of the economy. But for me, I always try to be as objective as possible. We all have our own thoughts and preferences for investing, but I always prefer looking at performance over the years to get a better picture of how things are unfolding. Right, so in this example over here, I just pulled out 5 kind of random but big international banks and compared it to the S&P 500 over a period of 10 years, and I selected the total return, not just price return, but total return, because a lot of the banks are actually paying a dividend, and that should be considered to be fair comparing it with the S&P 500, because obviously that considers reinvesting of dividends. So if I consider all these, I can see here the S&P 500 returned 157%. Obviously that's market returns and actually really solid performance when you think about it over a 10-year period. Now, the only bank that actually managed to outperform the S&P 500 is JP Morgan with a really nice performance of 263%. All others actually did very badly compared to the S&P. For example, Royal Bank of Canada. Now again, I'm not Canadian, I don't know much about the bank, but I heard the Canadian banking system is very solid. It's almost like an oligopoly with 4 or 5 big banks controlling the entire market. But when I look at the return, it's still less than the S&P 500. So for me, nothing really too impressive. UBS in recent news, they're obviously taking over Credit Suisse, but then again, their share price overall, 63% growth, less than half of what the S&P 500 did. Then we have the Deutsche Bank. I'm German, so I should be investing in German banks, but Deutsche Bank really underperformed strongly with a loss of 69%. I mean, that's just so disappointing to see. And lastly, we have another global powerhouse, HSBC, which only produced a 7% return over a 10-year period, considering reinvesting of dividends. So for me, honestly, that's really not impressive. Now, obviously, there might be some other banks like Bank of America, etc., that did have better performance, but it just shows you it's really hard to pick. You can have a good bank that performs well over the years, but you can also have a lot of non-performing banks. So in the example of Silicon Valley Bank, I mean, I'm sure a lot of people put their money there for a reason because they thought they're solid, they're getting returns. So for us retail investors, it's really hard to understand which bank is going to perform over the years and which isn't. And that's for me one of the worrying factors when investing in banks. So here are a couple of reasons why I personally won't be investing in banking stocks. So the first one is that it's very cyclical. And cyclical can be good, right? Some companies have more revenues during certain parts of the year, like Black Friday, Amazon sales go up massively, or other companies that specialize in Christmas sales, their sales go up towards end of the year. So that's all good and well. However, banks are very much cyclical to the economy. So when we have a recession and a downturn market, obviously banks are the first one to struggle because a lot of people are not really taking loans anymore or keeping a lot of savings in their bank account because they actually use their money at the bank to pay for their day-to-day living expenses. And obviously they're not going to make some big investments anymore because there's uncertainty, the economy is not sure, so people are taking less loans. And as you know, the fundamental business model of any bank is basically the difference between getting the deposits and the interest they pay you as somebody who deposits their money with them versus what they charge you for the loans or mortgage that you take out from the bank. So that difference, what you get in terms of your interest payment for keeping your money with the bank versus what you pay for taking money out of the bank in the form of loan, that's basically essentially the profit they make. So in good times with high interest, that's great for them. They really make a nice spread and some good profits. But in bad times, that spread is very little. Obviously, we had now a number of years with very, very little interest. They made a fractional margin amount on each loan they gave out. So that's obviously not very profitable. Now, clearly, a lot of banks also have investment banking, asset management, and other components to it. But the main business model of a bank is exactly that. So when we are nearing a recession, obviously banks are one of the first to struggle. And that's why we're seeing right now SVB struggling, and back in 2008, 2009, a lot of other banks also struggled and eventually collapsed. Another factor I don't like too much about it is the loan default risk. So basically banks are happy to give out loans, right? Because that's how they make money from the interest on the loans. Now I do have one serious question for you. Why did the banker quit his job? Because he lost interest. However, often, and we've seen that once again back in 2008, 2009, they gave out loans too fast to people that are actually not credit worthy just in order to make some interest on them. But what happens, a lot of them are actually defaulting on their loans. And if too many people default, once again, as we see on the housing bubble back in 2008, all of a sudden they're lending out more money than they actually have in deposits. And that's when the dominoes start to fall. Basically, they're being over leveraged. And that leverage is for me really risky. That's why I personally don't do margin trading, because I don't like using leverage. But banks obviously use that every single day. That's how they make money, which is great in good times because you can really multiply your revenue. But in bad times, when push comes to shove, that can really become your Achilles heel. And that's when we can see over leveraged banks start to collapse. Another factor I see for a lot of the traditional banks is tech disruption. And we can see the rise of challenger banks, neobanks, online brokers that only operate as an app. So they have much leaner cost structure and therefore can pass a lot of the savings onto the client. So for me as a customer, I prefer using a bank like Revolut, which is much faster, much more efficient, much more user friendly than some traditional bank that charges me a fortune. When I want to buy stocks on my traditional bank, they charge me 10 euro per stock trade. I mean, it's mind boggling, plus an inactivity fee, etc. So it's just crazy compared to some of the newer apps that actually younger people prefer to use. And I think they're going to get much more competition from those fintech companies that also start to give out loans and mortgages. And in the long term, I really think they will take a lot of the users away from them, and that will obviously hurt their profits. And lastly, you always have the risk of a bank run or panic kicking in. And that's, I think, what also triggered the SVB case, because a lot of people heard rumors that the bank might not be liquid anymore to pay back the deposits of customers of the bank. And sometimes this can just be triggered by a fake rumor. And there was a great anecdote about this in the Financial Times back in the 1980s when Hong Kong was about to be handed over control by China. There was actually a story when a group of people was waiting at the bus stop for the bus to come. All of a sudden there was heavy rain starting, and all of them at the same time went across the street and were seeking shelter under a little roof, and that happened to be right next to the bank. So all of the passers-by started seeing a lot of people queuing at the bank, at the ATM, and started getting worried. And the word spread quickly, and people thought because of China taking over, it's the best to take out the money out of my bank and take self-custody of that. So everybody ran to their bank, took out the money, and that's what led to the downfall of the bank. And that just shows herd mentality can really have often negative effects, even if it's just based on a rumor. That shouldn't be an issue because technically the bank is keeping the money for you, right? So you just go, take your deposit back, and that's all. But here comes the problem once again of leverage. Yes, the bank technically keeps your money, but that's just based on the fact that the bank assumes not all their customers will withdraw all their funds at the same time. They just assume that will never happen. And because they assume that, they're actually lending out some of the money more than they have in deposits. That's just how it is. And that's been working for them for centuries. But at the same time, if for whatever reason, word spreads, and we do live in an ever more connected digital world where information spreads like that, everybody pulls out the funds pretty much at the same time, the bank will collapse. And for me, that's just so risky and hard to predict when it will happen and to which bank. And that's why it's so important that I always recommend make sure you check how much your bank is insured for. In most banks in Europe, for example, they're insured up to 100,000 euros. So if you are in the situation of being lucky enough to have more than 100,000 euros sitting in your bank account, I really strongly recommend you open up a second account and send the balance, anything over 100,000, into that account. Because if that particular bank fails, at least you're guaranteed, at least that's what the governments in Europe guarantee us, they will compensate you up to 100,000 euros. So if you would happen to have 500,000 euros sitting there, you would be technically losing 400,000 euros. And I think that's just a huge risk to have. So instead, what I would recommend is have 5 different bank accounts up to 100,000 euros, and you will be fully protected and can sleep much better. Because once again, who knows, right? Your bank could be the next SVB. I mean, just look at Credit Suisse. That was such a powerhouse. Myself, I used to live in Switzerland for a number of years, and this bank is just the behemoth bank. I mean, every person in Switzerland either banks with UBS or Credit Suisse. These are the 2 huge banks operating internationally. I mean, it's a massive, massive company, and for them to fail and be acquired for UBS, honestly, it's just mind-boggling for me and just once again cautions me, because I would have definitely trusted them with my money. I mean, it's a Swiss bank after all, right? I mean, if any bank should be safe, it should be Swiss banks, and we can see what happened to them. And especially for shareholders of banking stocks, it's also really painful to see in the example of Credit Suisse. I mean, the biggest investor, Saudi National Bank, lost over $1 billion. Why? Because as part of the takeover, they have agreed on a takeover price. Basically, all shareholders of Credit Suisse stock, they obviously traded at market prices. At the time, it was just shy of 4 Swiss francs. However, as part of the negotiation and rescue mission, so to say, UBS agreed to pay out Credit Suisse shareholders at only 0.76 Swiss francs. So you can see that's a fraction of the current market price. And obviously investors didn't have a chance anymore to sell the shares before, so they basically had no chance but to be bought out at such a low price. So if you've been investing into Credit Suisse over the years, now you made a huge loss. And of course, that can happen to pretty much any company, right? I just personally think there's so much uncertainty about banks, especially so many things that we don't know that are going on behind the curtain, and so much leverage that I have no idea about. And we can see right now in times like this, it comes out. And as Warren Buffett always says, when the tide goes out, you can see who swims naked. And right now we saw quite a number of banks actually swimming very much naked. And another big challenge I see for banks going forward is the introduction of CBDCs, central bank digital currency. The idea is that central banks will take over, and there's actually no reason to have any more regional banks, because the central bank will issue digital tokens and the rest will be done through the blockchain. So there's really no need anymore for having a banking system. Now, I don't know if this will happen or not. Some say it will, some say it won't, but it's just another question mark I have about banks in the future. And for me, it's just too much of a risk to take right now. Now, will banks make a comeback in the short to midterm? Absolutely. I really think they will. So if you're more of a trader, then definitely I think there's absolutely nothing wrong with capitalizing on the rebounding growth of banks. And if I was forced to invest into a bank, it would probably have to be JP Morgan. I mean, here, when we look at the 10-year performance overall, looks definitely very solid, but that is now. Will they still be as attractive in 20, 30 years? I honestly don't know. And for me personally, there are just so many industries and sectors that I rather invest my money in, and I can't invest in everything at the same time. But personally, I won't be investing into banks, at least at this stage. But what about you? What do you think about investing into bank stocks? Let me know in the comments below. I'm always interested to hear back from you guys. Next up, check out the video over here. I hope you enjoyed the video. If you did, please give it a like, subscribe to the channel. It means the world to me. As always, stay healthy, get wealthy, and I see you in the next one. Ciao.